Good evening, ladies and gentlemen. Myself, Pallavarajan, representing PMS Bazaar, and I welcome you all to the second episode of Emkay Alpha Mavens Season 2. Now, there are about 8 crore demat account, roughly about 8 crore demat account in the country, and the interesting part is almost half the demat account have come post-COVID. And today, in the second episode of this Emkay Alpha Mavens, our guest will be discussing how investment behavior is changing over time with these new age investors. And broadly, the discussion will cover investing or trading, asset allocations, product to invest, new behavior of digital, important of 3W, which mean when to invest, where to invest, what are the expected returns. And to discuss this among us, we have Sandeep Bhardwaj, who is the CEO of retail broking at IIFL Securities. Sandeep has over 2 decades of experience in sales, revenue and wealth management. He has worked with angel broking, Religare Finvest, Centurion Bank of Punjab, HDFC Bank, and ICICI Group. Sandeep, welcome to the show and thanks for joining in with us today.
Thank you, Pallav. The privilege is all mine to share the dais along with all esteemed people here, and to all the guests who have joined to the show. It's a wonderful opportunity to share my learnings with all of them.
Great. And to moderate the show, we have 2 gentlemen from Emkay Investment Managers. We have Mr. Vikaas and Sachdeva and Mr. Sachin Shah from Emkay Investment Managers. And just to give a small brief about them, Vikaas is the CEO at Emkay Investment Managers and is an industry veteran with over 2 decades of experience. Vikaas was also the CEO of Edelweiss Asset Management prior to this current assignment and successfully turning around the business at Edelweiss Asset Management, culminating in the acquisition of JP Morgan MF, and was a global CEO of Enam Asset Management, where he oversaw both global and domestic side of the business. His industry affiliations include a seat at the Mutual Fund Advisory Committee, which is a special committee of industry professionals selected by SEBI to advise them on governing the MF industry. And he was also on the board of Association of Mutual Funds of India, heading the ETF and index. Because sir, welcome to the show.
Thank you so much, brother. Thank you.
Yeah, and the other side, we have the seasoned fund manager, Mr. Sachin Shah, who has over 2 decades of experience. By virtue of his extensive research, Sachin has developed E equal risk, which is Emkay's investment manager's proprietary model, which helps to evaluate and compare listed companies on various aspects of governance that has eventually proved in performance of Sachin's products. So Sachin, welcome to the show.
Thank you, Pallav. Thank you.
With that note, I would like to hand over the show to MK team.
Thank you, Pallav. I think there are 2 more introductions which I would like to make. One is, of course, you and your entire team at PMS Bazaar. I think you've built a fabulous business. This is a fabulous platform. And every time I come onto this platform to interact with my guests, I'm amazed at the level of energy and enthusiasm you and your team bring to the table. So thank you so much for giving us this platform. I would also like to thank Finlearn Academy. This is an academy which is into training, and dissemination of knowledge. They will be sponsoring the prize for the best question. So now let's just move on with the show. I think, as always, it's my privilege to introduce the person behind the professional. So Sandeep, I've done some spy work behind the scenes. I've spoken to your colleagues, your friends, your industry affiliates. And I just wanted to share with you what they talk about you. It's some very, very interesting things. Yeah, they describe you as aggressive, a go-getter, flamboyant, but more importantly, you're a very disciplined guy. And one of the ways your discipline manifests itself is in terms of your dedication towards fitness. You're a hardcore health freak. You're extremely disciplined and intense about your workout regime. You're a sports enthusiast. You love cricket, but on the professional front, when I talk to your colleagues, I said, tell me a few things which really stand out when you talk about Sandeep. So they said that you have extreme clarity of thought. This is something which resonates across your colleagues. You are very knowledgeable and you can add value to any discussion. I think I've been part of some of your Clubhouse interviews, and I can tell you that it really resonates with me. You actually dislike negativity and procrastination. one of the things you keep telling your colleagues is life is full of problems. I'm sure you have a problem. Come to me with the problem, but also come to me with the solution. What you think is the solution, then let's discuss. And that apparently makes you very, very decisive in terms of taking decisions. You're a very high energy person. Some of your colleagues actually call you an energy pulse, energy pulsar. And they tell me that it is very difficult to not be motivated. You cannot not be motivated. You go to Sandeep, when you're down and out, talk to him. Within 10 minutes, you'll come back refreshed and motivated. I think that is something which was very pleasant. It just resonates across the entire team members. You're very creative. You're very knowledgeable. Your attention to detail, whether it is from digital to algo, from flow charts to customer experience, everybody vouches for your attention to detail. On the personal front, you love traveling. Your Facebook page has photographs of all the destinations you've visited, but your favorite one seems to be Spain. I think that is something which you really like and you really enjoy. About your family, your wife Sonia is a PhD in literature, is what I believe, and she's currently working on a book. Amazing. Your daughter Siddhi, who's 17, she's just finished her class 12. She's looking at studying overseas, but one of the things which is very endearing about her is that she wants to be an entrepreneur. Naya Desh, Naya Bharat. Look at the way it is inspiring young men and women today. Your son Aditya is 13. He dreams of being an engineer, but his first love is becoming a Formula One sports race car. Am I right?
Absolutely.
That's good.
You did quite a lot research.
Yeah, and you actually have a pet dog, a Shih Tzu, named Buddy, who is actually the cynosure of the eye of the entire family. He's the apple of the eye of the entire family. Last but not the least, I think everybody vouches for a collection of shoes. Apparently, you have more than 30 pairs of them. Am I right?
Yeah, absolutely right.
Yeah, so that's pretty much what it is. Yeah.
So it's quite a lot. I am hearing about myself. And I don't get generally such opportunities where I can hear about myself and what my colleagues thinks about me. So thank you very much to nicely sum it up and make me also charged and motivated about listening about these things. As far as my wife is concerned, obviously she is doing PhD, as you rightly said, and that's really a big encouragement for me when she is pursuing her dreams after the marriage. Daughter, I'm very proud of, when she first came a couple of years back and said she wants to be an entrepreneur and she want to pursue her study in that and that stream. When it comes to my daughter, my son, he's quite naughty, as most of young children are. But when it comes to setting up his priorities as well as looking at what he wants to do in his life, that encourages me. The clarity of thoughts which nowadays children have. So these are Gen Zs. These are beyond millennials. So they're extraordinary. And when it comes to shoes, that actually sometimes what happens when you, whether it is a watches, it is a shoes, or the way you carry yourself. What I believe in, how you carry yourself throughout your day or a week or a life. It's all about self-love. I believe in the philosophy of a self-love. The way we get upbringing in life, we were responsible for one or another thing. We were looking at our parents. We were looking at post that the wife came to life, that the children came into the life. So we keep looking at towards others. We never get a time when we look at ourselves. So there is something called self-love. This self-love is nothing. Is all about how you look at the thrust within yourself and fulfill it. And that is what I personally believe in, Vikaas, that these small things, whether it can be, for me, it can be maybe the shoes or the watches or the personality. Everybody has the different way of looking at it. And I personally recommend everyone that what makes you more charged, what makes you more energized, one should look at it.
Wonderful. That's a great way to start off the show. In fact, I'm now going to ask Sachin to take over from here. Sachin, why don't you start off asking the questions?
Sure. Thank you, Vikaas. And thank you, Sandeep, once again for being with us. It's really a pleasure to have you.
Thank you.
So, let's start with the most hot topic, and it's something that I've always, not always, but in the last few years, and more in the recent years, is something what has always, I have been a little, something which I don't have an answer to, in the sense that in the last, if you see 3-4 years, and more so in the last, 18 months, particularly the post-COVID or say the last 2 years, we've seen a lot of new investors, new young investors, or new young participants. Actually, I think the right word will be participants. Whether they're investors or traders is something what I would like to understand from you. But a lot of new market participants, who have joined, because we've seen the number of demat accounts that have opened in the last 2 years itself, the number of trading accounts that have opened, right? And a good bunch of this is the millennials, right? As we all understand. But so just wanted to understand, what's your sense of this new bunch of people on the ground out here, and how do they approach to this entire investing, trading, or what are they really thinking when they're getting into the markets, and how are they actually playing it?
Very interesting question, Sachin. And everybody wondered that what has happened suddenly in last 2 years. But let me set up perspective. It is not has happened overnight. So let's understand the trend. And I'm going to share the few key data as well. So there's a paradigm shift in our investor class. The average age of an investor has reduced from over 39 years to below 30 years in the last 10 years. So every passing year, that this investor age is coming down. So when in 2010, I used to track this data, average age of a person who used to open demat account used to be close to 39. And if you look at current, it has come to below 30. It is, averaging at around 28 years. 5 years back, the industry demat account penetration was below 2%, which is now stands at around 4%. As Palla was saying, the first 10 million demat account got added in 7 years, between 11 to 18. Where the next 10 million accounts got added in 3 years, between 18 to 20. And the last 10 million accounts, to everyone's surprise, got added only in 10 months. So if you look at last 2 years trend, more than 60% of accounts are opened by millennials, which are new to the industry. And this also, people call it as a KRA, non-KRA. So these are the non-KRA clients, those who are coming for the investing world for the first time. So these are the data which suggest there's a tactical shift which is happening in the investor class itself. And the more younger people are coming to the industry. And when I fairly see the millennials wants to participate and diversify in the investing as well as trading. And why I say so, let me put up some numbers from a millennial point of view as well. So today, millennials comprise of 33% of the population. They contribute to 45% of the earning population of the country, and nearly 72% of them contribute to the household earning. If you look at average income of Indian household, which is approx 2 lakh, their average income of millennials comes to be approx 1 lakh. But it's not about the income difference. What is the big catch is about the expenditure ratio. For an average Indian household, the expenditure ratio remains over 60%. But for the millennial, the average expenditure ratio remains only 25-30%. Which suggests that millennials have more disposable income in their hand. Investing and trading, when I even look at Google Trends top key searches, investing and trading becomes the two large category of their searches around that. Now, there is another perspective to it, that though the millennials are there, they have more surplus income in their hands. Why equity? What's happening? What's happening in the equity point of view? Why it becomes overnight hot talk of a town. Now let's understand what's happening in last 20 years in this financial world. If all of you are aware, in the last 20 years, small savings and FD returns used to be over 12%. When your fixed income asset is giving you 12%, nobody will like to come to the riskier assets like equity, which is now stands in somewhere 5% or 6%, 5 to 6%. It means it is not even beating inflation to a large extent. So it is a zero-sum game. So if someone earns and puts their money into fixed income assets, they are largely mitigating inflation, or they are not even mitigating inflation. So their money is eroding. So, and now you look at last 20 years Nifty returns. I think if I am correctly remember, Nifty has given 14% CAGR in last 20 years. If I look at another point of view, Indian GDP is growing on an average rate of 9%. And inflation, as I said, it is ranging 5 to 6%. So if I extrapolate this, so Indian corporates are supposed to grow by more than 14%. So as a result, equity has become the preferred asset class of an investor. And from a millennial point of view, from a mindset of a millennial investor, the long-term wealth creation comprise of stocks, MFSIP, basket investing, stock SIPs, and ETFs. Whereas they also keep some of the funds from short-term trading activities. Because I see they don't differentiate whether they are an investor or they're a trader. They have fair, they're both legs in, both the trading options, trading as well as investing option, and they want to venture out in both. So I see that they are building in long-term wealth creation by way of stocks, MFSIP, or basket investing and ETFs as well. But at the same time, they are venturing the complex subjects like derivative. So that's what my take on this.
That's very interesting. So what you are saying is that they have a very open mind, and they are really out here on exploring things, and whatever can help them in achieving their financial goals, they are ready to work on it. If I can.
Absolutely. So the thought of, I think, to add to it, their objective and thought is very clear. They want to build long-term wealth as well as they want to venture out in trading. It's not either or.
Understood. Fantastic. Thanks. This helps a lot. So this is something, the trend that we've seen even kind of at least in the US market, right? The Robin Hoods, as we call them on the platform, it's very similar, right? Actually, this is also, and they are in a way a bit invisible.
Correct. Yeah.
Right. Yeah. Okay. Vikaas, over to you.
Yeah, I think the penny dropped when you said that the expenditure of these millennials is 25% vis-a-vis what it used to be earlier.
No, I want to quote one example, Vikaas. Also.
Amazing.
So I want to quote one example. On Saturday, I went for a coffee shop and I was just ordering the coffee, and the three children, they were appearing for children to me, and they were having some chat among themselves. And what they were talking, I just want to put up as a context setting here. One was saying that, and all three of them I could understand were CAs. One which said, I am, bro, I am earning 60,000. Another one said, bro, I am some 90, and and one was, I think, 1.2. And they were talking about where to spend the money. So they were not finding option to spend money. One said, yeah, I go to gym, maybe the gym fees or protein, I could spend 10,000 rupees, and my traveling expense, etc. But still have so much of surplus money, what to do? Now look at the topic they were discussing in a coffee shop. I'm just putting up. So they're finding it that if they have so much surplus money, eventually they will have no other option except coming to investment products.
Very interesting. But it begs the question, when you're talking about new age investors, are we seeing an over dependence on equity as an asset class at this point of time? The other way to look at it is that by virtue of assuming this over dependence on equity is indeed there, is the concept of asset allocation lost on most people who are coming into the the investment space right now?
Yeah, very interesting. I think we have grown, all of us have grown thinking about this question and hearing about this question. So I want to put up my perspective here is, if you look at 60% of millennial investors are investing for the first time, as I said, and the behavior, and their behavior clearly shows that they are careful about the money. They not only rely on historical stability, but also on a credibility of social and authentic reviews before investing. And most of the platform we have seen, millennials are social creatures. They leverage social to a large extent. So with this all reliable information at their disposal, they are making one of the most informed investor class. That is what I strongly believe in. And as I mentioned earlier, equity remains the most preferred asset class, contributing over 75%, which consists of direct equities, mutual fund SIPs, ETFs, global investing, and rest of that goes to debt schemes and some newer product like cryptos. So I feel that they are making their decision well informed, and they know what they are doing.
Quite possible. I think we at a generational level tend to underestimate what is happening as an undercurrent. So I would tend to agree with you. But talking about generation, talking about asset allocation, talking about ultra high net worth individuals, when you look at I'm asking you this because you've had a holistic perspective across the globe looking at investors. When you see the asset allocation pattern of, say, ultra HNI investors in India vis-a-vis that globally, do you think there's a marked difference, sort of a developed country ultra HNI asset allocation vis-a-vis a developing country ultra HNI asset allocation? Is there something which which you can give some
Yeah,
insight
so
on?
my point of view there is the developed country, there are a lot more maturity on thought process of investor, you know. And when it look at developing countries and ultra HNI customer, first of all, they're not DIY person. For them, do it for me. So that for them, this term becomes do it for me. And their primary objective is not the wealth creation, first of all, because the wealth they have already created. What is the second, what is the most important for them is wealth protection. So entire energy for ultra HNI customers from Indian point of view, I'm talking about, goes into the products which protect the wealth first. And their asset allocation. So there I see, they venture out into the products like fixed incomes. They invest in fixed incomes to a large extent, and they balance out as returns because what they look at is the fixed returns which they can generate over their portfolios. When I look at any investor which is millennials for that point of view, I'm just digressing your conversation and benchmarking it with the millennials. For millennials, I think the risk capacity is more higher than when I compare them with the ultra HNI customers. That's where precisely they are able to disseminate large portion of their incomes towards equity.
Interesting. Since you're mentioning this, I think I should also put up a few years ago, I was listening to this gentleman who had a startup. He was speaking at a panel discussion, and he had sold off his stake and he had made lots of money. Okay, so as is my want, I went up to him after the panel discussion and I said, "Listen, where are you investing your money? From the point of view, can I help you manage your money better? Why don't you look at public markets, equity, and all of that?" So he gave me back a very nice answer. I'm just putting that across because it's thinking which impressed me. He says, "Why should I invest in equity where it creates wealth only for me? I want to invest in other startups so that I can create wealth for other startups, which will benefit the nation." So I think this is something which was amazing to me. The guy must be 25, 27. But
yeah, so that is a big tactical shift. This is a big tactical shift because I think you rightly put this example here, and that is predominantly visible as well. See, when someone age of 45, 50 years old person creates a wealth, his entire thought process goes on wealth protection. But when a person who's 25 years or 30 years old guy, new generation guy, he has a money at his disposal. First thought process comes to how I multiply money by entering into some venture. That is the reason the entire India is getting into the startup culture. I can quote various startups, which has started from very basic to very large level, dependent, where the money availability was, higher or lower. From making a tea to writing a codes, this has become so simple to so complex. So the startups are venturing out. So that's what I clearly see. They not only contribute for society, but also look at how they can venture out from a newer territory and expand the vision at large.
Completely agree with you. I'm sure Sachin has a few questions on that as well. Sachin?
Yeah, that's an interesting conversation, and that leads me to there's a thought that's coming to me. Is that Sandeep, you did mention that they have a very these new age investors have a high risk appetite, and rightly so, probably because, as Vikaas mentioned, they want to create and share it with the nation or the community, and we were also saying this, but at the same time, we all understand that it's nice to take risk, but it's also important to have risk mitigation, right? And this do it yourself, right? We all call them the millennials, the DIY generation, because they just want to do it. They want full control of things, and they want to understand everything. And as you said, they are more open to things, right? I'm sure there is something that they need to get guidance, at least, if I can use the word guidance, on the risk mitigation, right? Because taking risk is one thing, and managing your risk is another thing. So
absolutely,
how should one manage the risk from their perspective? How should they try to mitigate the risk? Any thoughts on that?
Yeah, so this DIY is most talked terminologies nowadays across. But if you look at the digital behavior of millennials across platforms, such as Amazon, Netflix, Uber, or Zomato, these are completely DIY. Now, if some customer who's behaving differently on such platform, we can't expect them to behave differently on financial apps. So from account opening to execution, in financial, I'm talking about the BFSI space, where from onboarding or account opening to execution, everything has become DIY now. Right. Even just to set up a context, at IIFL Securities, more than 70% of customers are getting onboarded through DIY. Wow. But post-COVID, I want to put up now another perspective. Post-COVID, most of the customers who entered the market after more than 40% correction have seen huge or healthy returns, I must say. But important question is not about that return. Important question is to have right expectation of return in the long run. Is it sustainable? So when I see, a lot of people ask me at various events that in last 2 years, I generate more than 100%, 80%, 70%. So they talk about mind-boggling numbers when it comes to return. But is it possible to keep generating this kind of alpha? My simple suggestion is that you have to look at it sustainable returns over the period of time. Because there will be times when the returns may be even negative or they'll be flat. The markets will be flat. But in a long run, if you are able to generate good IRR over your portfolio, that is what one should look at it. And as I quoted already, the last 20 years, 14% CAGR, and Nifty has given a return. And even you multiply, if you invested 1 lakh 20 years before, what that money would be after, with 14% CAGR. So that is very one important equation for investors to understand is the expectation of return over the period of time. Else, it derails your entire investment objective. Because you can't sustain with such kind of high returns, consistently. These kind of events, whether it is a COVID or Ukraine, or these kind of events are not regular events. This happens once in a while. It's good to modify your portfolio or buying a good stocks at the point in time and generate a better quality of your portfolio. But as far as return is concerned, my advice is that one should be pretty clear as far as what returns they are expecting from equity as a standpoint. When it comes to trading, what is more important is we should look at that what is trading. When I look at the end trading, I believe is a zero-sum game. Unless, important is this, that why it is zero-sum game. Unless you are focusing on knowledge building, knowledge enhancement, technical skills, discipline, risk management, and position sizing. If you work around this framework, I think one can, even with a probability of 60-70% accuracy, can make a good returns even at trading. And if there is a blank safe, go by tips and you have heard something on Twitter or some social media what to do, and you just go and execute, you may be lucky once, you may be lucky twice, but not be lucky regularly. So one should invest time and energy in building and enhancing their technical knowledge as well as skills. And one should be disciplined in terms of their risk management. And the biggest thing is position sizing. I've seen people deviating their position sizing as and when the markets get corrected by averaging their positions, which makes the entire journey difficult and they lose their entire money overnight.
Yeah. So Sandeep, I have a follow-up question to that, and which probably actually is more, I'm more senti to that because it's more relatable to me. But before that, on a lighter note, you said trading is a zero-sum game, which means effectively that if Vikaas is earning 100 and I'm losing 100, it's a zero-sum game. But actually, to my mind, it's a minus-sum game, because if Vikaas is earning 100, he gets less than 100. If I'm losing 100, I lose more than 100, because that whatever that extra goes to IIFL Securities as a broker, right? So,
yes.
So I'm just saying that actually it's a minus.
Yeah. Correct.
But, looking at the transaction cost, right?
No, it is not only IIFL Securities, the government also.
No, I meant any transaction.
And all. So there's a transaction cost behind. So there's a transaction cost behind.
I think the underlying thing with Sachin is trying to say invest more money, stop trading. I think that is what he's trying to say.
No, I'm not saying this. I'm not saying that. What I'm saying
sorry, Sachin is trying to say invest more money. Sorry, my bad. Sachin is trying to say.
I will always say that because I want money on the investment side, so I have to make some point. So, but that is where I'm coming to the next point. The investment products that we have, and which there has been very little innovation. There has been some cosmetic innovations in some of the products on the investment side. I'm talking about whether it's an index fund, whether it's a long-term holding buy and hold product and all of that. The question is, are the new age investors able to relate to those products? Do they understand these products, right? Or do we really need to create some new products in terms of what, meeting their goals? I'm talking about the investment products.
I think we are still developing countries, and there's enough headroom for the maturity of our existing product itself. That is what I firmly believe in. And any which ways, the markets are evolving, the products are evolving. But it is not possible that you overnight dump so many products to the markets and get a mind share. See, any which ways, if you look at cryptos, was top of the town. So newer products will keep coming, but it will take time and energy to stabilize and get a larger mind share and penetration. So that's what is more important. But what I largely feel in when it comes to contextualize in terms of millennial, our education system is evolving, and foundation of financial literacy, it starts from school nowadays. And as far as millennials are considered, I find them very inquisitive nature, making them most informed investor class. That is what I have personally seen, that when I look at webinars or Twitter spaces or Instagram or wherever you go, I find them everywhere. And in addition to social engagement, they have created a sense of validation around. So for example, if I, as a nature of a person who is, over 40 years, over 45 years, I'll call Sachin, Sachin, kya karna hai, batana. Sachin ne bataya, and I executed it. And if suppose I am a person who is a millennial, Sachin, please tell me what to do. And Sachin has told me that I'll go to Vikaas. Sachin has told me this. So what exactly, is this mean by? How is it going to work? Whether should I do it? Not should I do it? Then I'll call, hey friend, who's my classmate? I'm doing this. Are you aware of what's happening in this? So the sense of validation actually is playing a very in their favor. That's what I feel in. And how much one knows about the financial planning, when it comes to millennials, the data clearly shows. I go through all the financial products which I look at. Their portfolio consists of well diversified from stock equities to mutual fund that to diversified from equities as well as tech saving, debt products, even now global investing. So they're venturing out across all the possibilities which are available in financial space.
And also
ETF
cryptos.
Obviously cryptos, and the cryptos, if you find, I have hardly seen anyone who is beyond a millennial age in cryptos. ETF is an emerging world. So when I talk to such young people, they like ETF because they simply say that that resonates with their ideology. So financial industry largely has evolved. When I look at from physical to kind of platform driven industry now. And this modern age investment platform, have made it easy for millennials to invest in a range of products. But the availability of such products has become quite easy. When I started my investment journey, and if I had to invest in mutual fund, first of all, I had to travel and go to some EMC, I would take a physical form and fill an entire form and do a SIP, then I had to give a check. So there was cumbersome journey even of investing in a plain simple product like mutual fund, or insurance was like hell if I had to take an insurance, or maybe a bank account opening was like the kind of big sheet used to be given to people to fill and give it. Then bank manager, you have to go bank manager, talk, approve, and then your entire stuff will start. And every damn thing used to take minimum 3 days, 4 days. Today, the moment you have a thought, there are a variety of apps available, and you just download those apps, or most of these apps are free of cost, where largely things are DIY in nature, and you go and just click a button, you do fund transfer, and your journey is on. So that's what is happening at IIFL app. IIFL market also offers wide range of investment products ranging from primary markets to IPOs to global investing, bonds, mutual funds, tax planning, and many more. With such a millennial focused investing ecosystem, we are transforming rapidly towards the right direction. Whether we are arrived there or not, that is still long way to answer. But we are going into the right direction and cater tech savvy generation of investors.
That's a good point, Sandeep. So just taking a cue from one of the chat questions has also come. See, as you said, the millennials have the accessibility to the products, to the investment pipelines in a much better way. And they are used to that, as you rightly pointed out, that they are already used to working on the Amazons and the Mintras of the world. So they have this experience of, as they call it, instant gratification, right? The instant gratification is something what they are born with now, I feel like, right?
Correct.
But when it comes to investing, getting into the whole business, yeah, you need instant gratification, as you said, opening the account, getting into investing and all of that. But making money is not going to be instant gratification, right?
Absolutely. Absolutely.
One will need to have patience. So I think from that perspective, a lot of guidance maybe is to be given to them, or maybe if they Google a lot of things and they study about it, or if they see a big dip like what we've seen in the last few weeks, maybe that will probably help them, right? Because that is I don't think you can escape that part.
Absolutely. Say you can do DIY everything, but DIY what at the end is execution. DIY and DIY doesn't solve your problem to identify. So that what you're going to do that cannot be resolved only by do it yourself, unless or until you have clarity or a product or a platform is helping you to discover that. So discoverability becomes a big challenge. And now I think with the use of technology, I see the fair amount of discoverability is happening. The kind of tools are available, the kind of products are available. I see that is also being addressed to a large extent. But one has to have knowledge of even understanding that and take a right decision.
Great. Vikaas,
it's actually very sorry. Yes, Sachin. It's actually very interesting. I picked up a word which you mentioned, validation. Okay, and when I picked up second word, platform. If I just combine both of them, today's generation, if I forget about today's generation, even people like me, when we have to pick up anything on a platform, we look at validation in terms of ratings.
Yes,
you're absolutely right. I completely agree with you. So why should it be different for an investment product? For this generation who's used to validation, they will ask people, they will surf the net. And, as I'm hearing you speak, it somehow, there was a question that maybe these youngsters have never lost money before. There will always be a time when you lose money. But I think this whole information superstructure which is being created, this is acting as a safety net. You will keep validating, you will keep talking. So your propensity to lose money might be a little lower than what it used to be earlier. So I think that's a very interesting point you talked about.
And emotional bias. So just to add to what you said, Vikaas, is when I see these young chaps, I see that they are not emotionally biased.
Correct.
They are very clear in terms of what they need to do. And so when it comes to, I'll set an example. When a person who is 40, 45, they normally becomes emotionally biased towards their portfolios or towards their trading behaviors, and they end up doing a bigger mistake. But when I look at their behavior, they are very particular in terms of booking profits, booking losses.
Absolutely.
So that's what I've seen, that there is a tactical change in behavior of in investor class.
Very interesting. So sooner than later, I hope that trading might move away from being a zero-sum game, and people start making more and more money in trading. Hopefully, I think that will attract a lot more, far more number of people into the capital markets. I think that's a phenomenal point to mention. So you also mentioned in terms of creating an ecosystem, dispensation of advice to DIY customers. I have a question for you, which is, and it's actually one of the audience questions also, which has come in. You see, it's at your scale, when you have so many investors and you have so many investment products, for a guy who's a little digitally savvy, technologically adaptive, he does get access to this advice. He gets it. But I believe, and I may be wrong, and this is why I'm asking you, that this advice is probably a little less democratized because a lot of people are not technologically savvy. So if I don't understand technology as well as, say, a guy my age, who's very technologically savvy, I would tend to be at a slight disadvantage in terms of the information flow which I'm getting. So how does your firm try to plug this in terms of democratization of advice through both digital and non-digital natives? Yeah.
So it is a very, very important question, that technology, how the technology or any organization is helping customers to adapt. So technology, no doubt, has enabled accessibility and enhancing execution across platform. So largely, I see that everyone is working on execution side. But the question is what to execute. As I said earlier, is what to execute. With this too much of information easily available, also derails your execution abilities. as well as discoverability becomes a point of contention. That is what is also is truth. So
can you just elaborate on that? Discoverability becomes point of contention. I didn't get that.
So when you go to any financial app in terms of trading, and that's easy to get into, but when what you want to execute, say for example, I want to buy a stock. Now there are a list of stocks which are available. Now which stock to buy, what not to buy, or when it comes to trading, and if you are doing a derivative trading, how to start first of all, what is the right product for me? So this is what is discoverability. And as I mentioned earlier, the 60% of the people are new to the industry. For them, this first few experience will become a lifelong experience that will signifies their future journey in financial world. So that is what is the right discoverability. And as I said, though they are inquisitive in nature, they are social creatures, so they ask a lot of questions. They venture around into the internet and try seeking as much as information as possible. But as it is also said, that too much information is also risky, and which also confuses one person to take decisions. So what we are doing at IIFL Securities, we're thinking like a millennial to solve the problems of millennial. So we have taken a step forward and creating our mobile app to provide an integrated digital experience. What does it mean? It means that which will help not only onboard them, but also doing a discovery and engaging throughout their investment journey. We're providing them hyper-personalized experience through technologies like artificial intelligence, machine learning. We're creating a data lake which can help them to not only do discovery, but also onboarding, engaging, and servicing throughout their app experience.
Very interesting.
And it is said and done. The more you focus on your customer, like a customer, then company become more resilient towards your consumer needs.
I think it's quite interesting because you're saying you think like a millennial before you address a millennial's problem. There's no inside-out view of looking at things. It's more outside-in.
Correct.
Maybe there's a feedback loop which you're getting, which is helping you improve further and further. Very interesting. In fact, one of the things I picked up along the way when I was talking about IIFL Securities is that you have a 3W framework.
Yeah.
For new age investors. Since you're talking about millennial investors, would you care to elaborate on that, the 3W framework?
Yeah, so it's very interesting when we say the 3Ws, and this is not new, and everybody knows that when, where, and what. These are not normally it's called 3W. And if you look at 3Ws from financial world point of view, so it becomes when to invest, where to invest, and what to expect. So to summarize this, investment is when to invest. So investment is a journey, rather a destination to a large extent, if I need to philosophically say this. And I believe that one should have to start investing as soon as they start earning and compounding takes time. And it's like giving time to your money, Vikaas, to earn for you. The more time you give to your money, the money becomes your children and you start earning for you. That's what the magic of compounding. And it requires discipline and commitment to stay invested. So I've seen people keep on churning their portfolios regularly, and that's where they lose out the bigger gain. And one should not miss if someone has not even started today. So I strongly recommend that today is the best day to start, irrespective of whatever you missed it. So that is what is when to invest. When it comes to where to invest, I think one should, before answer this question, one has to define their goals and objectives before investing. And I think millennials are very precise in that. They know what are their short-term goals, what are their medium-term goals, what are their long-term goals. So that has to be, first of all, defined well. And for long-term goals, equity is the best asset class. That is what I already explained. And they can invest. Now, there are a variety of options which are available within the equity itself, like stocks, MFSIPs, ETFs, global investing. And I recommend then you should choose 10 to 15 good businesses in terms of value creation. Keep on investing on those businesses, keep on reading about those businesses, and keep building our portfolios. And utilize all such opportunities like market corrections to buy more and creating the very good qualitative portfolios. And MFSIPs can give you opportunity to encash all timelines regularly and can stay invested very disciplined over the period of time. ETFs is another world which is emerging. For medium-term goals, they can invest in balance funds, fixed income products such as MFs, bonds, NCD, and gold. And for short-term objectives, they can invest in short bond funds, etc. So when you align your investment products with your objectives and goal, the chances of going wrong becomes very less, minuscule. You can't invest everything in equities, as you I think last time also asked, that there's over dependency. So that's where you can kill the over dependency on only on one product. And what to expect? I think, as I mentioned earlier, equities have outperformed GDP and inflation in the long run, and it can continue to provide a healthy return over corporate earnings and inflation.
Interesting, very interesting. I'm just making notes alongside while you were talking. I'm getting a lot of audience questions also. Sachin.
Yeah, I had one, because Sandeep has been talking about the technology that they have been actually implementing. And obviously, we all know the way IIFL has actually, grown their business on technology platform. Recently you actually onboarded a very large family from the Karvi set of investors, right? So how has technology helped you to seamlessly get them onto your platform, expose them to your framework, get them your right advice, get them into your set of business culture? How seamless that whole thing has happened, and how has technology really, because it's a very, very large pool of investors or customers, right? And I'm sure it's only technology that can really give you a very I would say an equal experience to all of them.
Absolutely. I think before getting into technology for Karvi, the larger challenge was to give them a confidence.
Sure.
So first of all, we welcomed all the Karvi investors with a holistic mindset. And we are proud to say that we have used technology seamlessly to provide them our omni-channel single onboarding stack. What does it mean? It means that we gave them one-step DIY journey where they need not to go through the pain of entire, again getting onboarded with IIFL. So because these are the same customers, why have they to go through if something has happened with the Karvi? So it became a complete one-step, DIY account activation for the for their investments and trading need, and turnaround was less than 1 minute. So less than 1 minute, you can reactivate your account. So that's what we did, and majority of them are able to activate their accounts and see the details of their accounts at their disposal. Our market app, as I already explained that. So we have already provided our access of our platforms instantly after activating their KYC. Our in-house advisory, because these customers are pretty old customers. These are last 20, 25 years customers in the Karvi. So, and they have way of trading and investing, but they also upgraded in their investment life cycle. So, keeping all those things in mind, we prepared our entire stack. And so from in-house advisory to recommendations from on MF, because they are also good customers who are investing in mutual funds as well as IPOs and fixed income assets. So providing them entire information and reaching them digitally, that is what we were able to fix that. And that empowers them to take a right decision at a right time basis, looking at their risk appetite and trading preferences. One of the things which we also did was to realign their portfolio, so that we can recommend them the right portfolio advice, what they should do on their current holdings and all. So that is actually gave them a large confidence that yes, that we are there for them, and we are there for them to value add. It's not a takeover, or it's not a Karvi accounts and move to IIFL. It is like entire theme is basis value creation.
In fact, Sachin, before you ask the next question, we have got a lot of audience questions coming in, so probably this could be the last question. We are already running out of time. It's amazing how time flies. But on this Karvi thing, just before Sachin, you go ahead, I'm reminded of a statement I heard a long time ago. When it comes to investing, comfort is more important than conviction. And I think whatever you've talked about getting the Karvi family on board, it is basically dovetailing into that. Very nice.
Yeah, absolutely. And particularly when it comes to finance, I think it's always comfort above conviction, and and trust, of course. Comfort.
Absolutely, yeah.
Certain last question.
One last thing from my side, because
sorry about that.
Really giving us a lot of insights, and I don't want to miss this chance. Sure. So, Sandeep, there has been another very interesting statistics, and this is something what I have also observed myself, that we have seen over the years that a lot of women have actually got actively participating on the investment sides, on the trading side. In fact, there's some statistics which also suggest that it's almost 30% now, right? But when you go a little more deeper into it, then you probably sometimes realize that a large part, maybe 70% of that, have been driven by the man, the husband or the spouse behind them, or somebody in the family who, on the male side, right? So I'm sure, but the women at some point in time, or even during this journey, want to actually get independent about it, right? So are they are they curious enough to learn, and are you doing anything to educate them?
Okay. So, very interesting question. I think women stay around the corner as well. So I want to give my 2 cents on this. So when I look at millennials, first of all, so you can't bifurcate, because they're going to be man, they're going to be female. There's a Indian population ratio which is divided between men and women. So that millennials are also going to follow the same, So what we need to look at and how we should look at this 30% data. So we did one analysis, and I found that people who are the women which are less than 30 years of age, and the women which are more than 30 years of age. Well, largely I feel the people who have crossed 30 years and their accounts have been managed by their people, maybe their husbands or their parents. But when it comes to people, women who are younger, their age is less than 30 years, I primarily believe they are the users, being millennials in pace. So I see fairly 15% contribution coming from the people who are less than 30 years of age. So this is kind of 50% split, and they are no different than any male. So their knowledge levels, their education levels, they are, as even I see them more intelligent. I keep on going to the Twitter space, and I keep on reading various views about women. There's so many women influencers are there on Twitter. They talk about finance, and they have millions of followers. I feel very happy when they are not only disseminating the financial literacy, but also encouraging so many other women to come to the industry.
Sure.
I think whatever time has passed by, so other, the women, when it comes to over 30 years, I think they will also get encouraged. Because we have seen times, my mother used to keep money at a home as a liquid cash for emergency, purposes. We have seen that time, and now when we look at that move to fixed deposits. Now that fixed deposits, it moved to mutual fund SIPs. I'm sure the transition is happening, and that mutual fund SIPs they will migrate to a little more complex subject like equities and other financial products. So I see a technical shift is happening, and newer age people are coming to the market, and they are surely going to educate many more.
I think you put it very well. Who better a role model than our Honorable Finance Minister, who's managing the finance of the entire country?
Absolutely, yeah, absolutely.
So, in fact,
and we had the MD of our biggest bank who was female. So there are many examples.
Absolutely.
So many startups. Zomato startup recently. Everybody knows that story. So many women. If I start picking up women's entrepreneurs or women influencers name, it will take another 1 hour. So that kind of penetration is there.
No, I think this question has sparked off a lot of chat already.
Because if I can add on a lighter note, when I joined the industry 20 years back, my senior told me, you want to join, but this is a very boring industry. You will not find any women around you to work in the culture. But now it's getting very different, I guess, from what I hear. So it's going to be interesting.
And one thing I want to add, day before yesterday, I was taking an interview in a product side for AIF and PMS. Believe me, I met across one girl. She's well educated, did her CA and CFP, and the kind of knowledge I could see, the kind of clarity, and so that's what I'm talking about. This kind of industry and this kind of complex product, I see a fair amount of participation across men's and women's. I don't see there's this bias, gender bias, in the next few years will be there.
Completely agree with you. In fact, Narendra P in a chat box is saying he's made a definitive statement. He's not even asking you. He's saying money is managed by women smartly. They manage it smartly than men. It's recent data.
Absolutely
so I'm not arguing with that at all.
Absolutely agree. And I say we should listen what Narendra is saying.
Yes. I'm just going through the chat comments first. Praveen, I'm not able to get his full name. Praveen Bramley, I think so, is talking about a large number of investors are following others without understanding deeply. He's talked about one or two advisory platforms in which very quickly they can make a decision based on performance. Today, they're venturing only in equity and discounting other asset classes. Why can't a company like yours, okay, this is a statement if you want to comment on that,
Sure.
hire more investment advisors so that understanding of risk is better and offerings are customized properly. Everything cannot be tech.
No, absolutely agree. I think I want to comment here is I strongly, Praveen, believe in that. So we have various business models, from DIY to do it for you. So we have a wealth management in-house. So we have more than 700 RMs who deals with helping all the people who have created wealth in their life and not only protect wealth, also how to generate alpha over their returns. So I completely agree. And there would be people, there will be exceptions where even in spite of earning wealth, they want to do it for themselves. But what is more important is the value of time. Well, once you have created a wealth in your life, the value of time becomes more important than only venturing out of self-exploration. So you want to extend that role to a much more qualified person who can help you and can guide you to build wealth for you. So we are already there and we are working towards it. We have a good amount of HNI customer base and we manage more than 1.25 lakh crores of AUM, under our belt. So and online is one thing. So which is completely DIY for newer age of customers.
Last 2 or 3 questions, Sandeep, if you can answer them very briefly, because I think we're close to our time. We're almost there now. You may choose to ignore some of these questions because they're on the markets, but one specific question is the current situation dampening the behavior of investors, especially in equity markets, and how would it impact investments? This is from Ankit Gandhi. Would you like to take that?
Yeah, sure. Why not? I think one, I'm not saying the war or the COVID or such situation are the welcome situation, I think these such things should be, as far as war is concerned, this should be criticized. And as far as COVID is concerned, nobody would like to have this, in their entire life, or even the future generations to come. But I think one gets a good opportunity because I've seen historical data. Whenever such wars have happened or such calamities have happened, equities have rebounded, strongly. There's a V-shaped recovery, and the markets have given always good recovery because the markets are forward-looking. Markets never look at backward or the present-looking. Such events are always discounted in the current earnings or the current market. So if you've seen the market tanked yesterday, they already discounted the event to a large extent. And what market doesn't like is uncertainty, and they discount uncertainty to a large extent, and they become forward looking. So and this Ukraine or Russia is not a perpetual event which will keep lingering on over the period of time. And these are fabulous opportunities. I think you can, if you understand technicals and fundamentals, you can identify a good portfolio for you, and can keep accumulating at a various intervals.
Interesting. I think questions are coming in thick and fast. So very quick answers, Sandeep. What do you think is a reasonable CAGR return over a period of 7 to 8 years cumulatively across all asset classes? This is a generic question. It will depend a lot on asset allocation. But if you have to look at, say, your own assessment for your own wealth across all your asset classes, what do you think would be a reasonable rate of return for you?
So if I look at this way, if your portfolio consists of 60 to 70% equities and remaining 30% remains around fixed and other income other asset classes. So I think 5 to 6% over inflation is a decent return to expect for.
Very good. 5 or 6% above inflation. I think that's a very definitive answer, Mr. Krishnan. So there are a couple of questions which I am just combining. One of them, Ajay is asking, despite assessing all valuations of stock, it's continuously expensive, like 40 or 80 P. When to buy them? That is one question. And simultaneously, there's a comment from Rohit which says that one should go all in because everything is cheap now, from equity to personal loans. So two diametric points of view. What is your comment on that?
So, I think when it comes to high PE stocks, the high PE stocks are not high because the markets are given a high valuation because there's a value there. And cheap PE stock is cheap because there's no value there or there's a less value there. So PE doesn't define, the multiplier of PE doesn't define that this is costly or there's a cheap stock. What is the value in the business? That defines, so rather than blindly looking at PE as a filter to identify the stock, one should be mindful in the business, what business is offering and how the business is going to grow in next 10 years or 15 years. So today you start investing and business is going to wipe out in next 7 years in spite of the PE being cheap or the PE being costly. There's no point investing. Go the equities are long-term investing, building portfolio long-term investing. So I think one should mindful for that. And when it comes to everything is cheap, so is crap. So, one should be mindful not picking up crap in the cheap, because everything is cheaply available. Then you end up buying, mix of things. So one should be mindful for that.
Correct. So there's just one question, because I think everything else you've answered. You've answered about what is your view on the markets in a way, mid and small cap correction. You've talked about. Srishti was asking these two questions. Kashyap is asking about everyone understanding the magic of compounding, Kashyap Javeri, and long-term investing, but nobody practices the same. We see peak flows coming at the peak of the market and people getting scared. I think that is, he's talking about sensitizing people during such a scenario. I think it's an evolution. You've talked about a variety of initiatives you've taken.
See, one thing I will talk about, because, normally people get confused with the FI selling, FI is buying. I think this is nothing to do with their investment, because you can't control FIs. What you can control is your own behavior and time to make your portfolio. FIs are doing their business. So if they have come to the market to buy something, one day they have to sell, isn't it? They are also into the profit booking. So, correct. And if they are selling something, it means that the markets are getting corrected. They are giving you a opportunity to get into the business. If everything is growing and growing and growing, believe me, you will not be able to buy any stock.
I have one question which I think probably, if it's okay with you, could be the question which wins the prize. And this is the last question. Jatin is asking, how do you guys, I'll leave it to you because that's a question for you. How do you guys follow risk management in times of war? Do you have risk management which is catering specifically to a situation like that? It's a very interesting question.
So he's asking on an organization level, or how he's asking for?
He's asking how you guys. So I'm saying it could be in terms of. So let's put it from a point of view of an investor. What do you recommend to an investor to do risk management? If you want to talk about an organization perspective, fine. But I think he's asking more from his
investor point of view. Good organization point of view. I think everything is the risk
everything is done.
Core, core pillar of a organization building. So we are well protected on our risk management, risk management side. But when it comes to investor, I suggest two things. If you're a long-term investor and you're building a portfolio, and there are 10 to 15 good businesses are there, and those businesses are getting corrected more than 10%, 20%, would you like to get out of that, or would you buy more of such stocks given opportunity? And maybe, one more advice, sometimes we get into the business which is good, which is looking good today. And over the period of time, we find that it's getting corrected and losing the market share. And there's no, growth story remain there. It's better to move out of such businesses and get into the business which is growth oriented. There's no point of averaging our losers in your portfolio. Sometimes it is also to accept that is going wrong and we did a mistake, and there are enough opportunities. Because equity is not about, finding a few stocks for you. Equity offers you good opportunities. One should be mindful in identifying such good opportunities. And if you don't understand, another piece of advice is, if you're unable to understand, mutual fund is a good product one should invest in, because you believe in fund manager. He's a more qualified person and he will do that job for you. You can keep accumulating by way of lump sum investments or mutual fund SIPs. There are a variety of long-term objectives, basis or long-term or short-term objectives. There are a variety of products which are available in mid-cap, large cap, small cap. You can identify and resonate with your investment objective and can stay invested.
So I'd just like to add to this and close this out. I think, Jatin, one of the first things you should invest in is good advice. Okay, a good advisor, a good advice, because the moment you have that, it will make you curb your impulses in terms of taking any knee-jerk reaction during a time like this. I think I speak for all three of us that all three of us have advisors, although we are all sitting in the middle of information, the midst of information, the center of information, but it always helps to have a sounding board whom you can go and talk to. So Jatin, my two bits to add to what Sandeep is saying, please go get a good advisor like IIFL Securities, and I think it will be worth your while. So I think there was a very nice question I'm not going to ask now because I've exceeded the time. What should be the asset allocation between trading and investing? So I'm not going to ask that. But I think this conversation has sparked off a phenomenal amount of questions. I think it has found resonance across the board. Thank you so much, Sandeep, for your presence. I quite enjoyed that. I made a few notes myself. It was very, very interesting. Thank you so much, Sandeep.
Thank you, Vikaas. Yeah, thank you, Vikaas. Thank you, Pallav. It was a great interaction with all of you. And I thoroughly enjoyed this entire interaction. I'm sure our audience will be benefited out of that. And if they still have any questions, they can email us on, maybe you can share the email ID. So we can later on, we can respond to them.
I really appreciate that, Sandeep. And gentlemen, thanks so much for your insights. I really appreciate taking your time and sharing very interesting information and data. Thank you so much, participants. Thanks for joining in and look forward to hosting another Sachin. Thank you. Thank you, everyone.
Thank you very much.